Hello, listeners. Welcome to the Morning Market Update, the podcast powered by AI. I'm Joe.
And I'm Sarah. Today is February 13th, 2026. Let's dive in. We are starting with a very complex picture in the U.S. markets this morning. Even though we just got a consumer price index report that actually looked quite favorable on the surface, the markets are striking a decidedly bearish tone. The January CPI showed consumer prices rose 2.4% annually, which was actually lower than the 2.5% the Dow Jones consensus was looking for. Normally, cooler inflation would send stocks soaring on hopes of Federal Reserve rate cuts, but the major indices are struggling. The S&P 500 has broken down below a key technical support level, and the Dow Jones Industrial Average reversed its gains almost immediately after the report. What's really driving the anxiety today isn't just inflation, it's the AI scare trade. We're seeing a fresh sell-off in sectors you wouldn't expect. Trucking and real estate stocks are dragging down the indices because investors are suddenly terrified that AI disruption is moving faster than companies can adapt. The Nasdaq is under pressure as heavyweights like Apple, Nvidia, and Tesla remain in the crosshairs of this volatility. Meanwhile, the Russell 2000 is feeling the heat as risk-off sentiment takes hold. It's a classic case of good news is bad news, where a decent inflation print isn't enough to offset structural fears about tech disruption and the looming impact of trade policies.
That cautious sentiment is definitely crossing the border into Canada this morning. The TSX is looking at a muted open, largely because of what's happening in the commodities space. If you look at the energy sector, which is the lifeblood of the Canadian index, there's a lot of downward pressure. Brent crude is tumbling toward $67 a barrel, and West Texas Intermediate is hovering around $62. That's a second consecutive weekly loss for oil, fueled by signs that the U.S. is seeking more time for a nuclear deal with Iran, which is stripping away that geopolitical risk premium that usually keeps prices propped up. On the TSX, keep an eye on the big divers, specifically the financials and the miners. While the lower CPI in the U.S. might give the Bank of Canada more room to breathe, the weakness in materials is hard to ignore. We're seeing a significant drop in aluminum prices as the Trump administration looks to narrow the scope of its tariffs on certain metal products. For a resource-heavy index like the TSX, these shifts in trade policy and commodity pricing are creating a lot of friction. We're seeing some winners in the tech-adjacent space, but the heavy weights in energy and mining are likely to keep the TSX in the red or flat for the session.
Moving across the Atlantic and over to Asia, the international picture is just as jittery. In Europe, the FTSE 100 and the DAX are struggling to find momentum. L'Oréal shares took a hit this morning after the French beauty giant posted disappointing fourth-quarter sales growth. They missed analyst expectations, largely due to a slowdown in their luxury division and ongoing weakness in China. On the flip side, we're seeing a surge in defense stocks. Kongsberg, the Norwegian defense group, is seeing massive demand for anti-missile and anti-drone systems. It's a stark reminder of how the current geopolitical climate is reshaping European industrial priorities. Over in Asia, the Nikkei 225 ended the session on a cautious note, while in Hong Kong, the Hang Seng is undergoing some major surgery. The index compiler just announced they are adding the EV battery maker CATL, the miner CMOC Group, and jeweler Laopu Gold to the benchmark index. This shift toward new economy and strategic mining stocks is a big move for the Hong Kong market. Meanwhile, in India, the Nifty 50 remains resilient but is keeping a close eye on the volatile gold market. Interestingly, analysts are pointing to unruly Chinese speculators as the reason for gold's sharp price swings lately. In the currency markets, the dollar remains dominant, and in crypto, it's a bit of a bloodbath. Bitcoin has dipped below the $66,000 mark as Ethereum tests the $1,800 level.
Turning to our major North American corporate stories, the headline of the day is undoubtedly Pinterest. Shares are cratering, down 22% in pre-market trading. The CEO was very blunt about the cause: tariffs. He noted that the largest retailers are being disproportionately hit by new trade levies, and, as a result, they're slashing their advertising budgets on the platform. It's a warning shot for any company reliant on ad spend. On the opposite end of the spectrum, we have Instacart. Their stock popped 14% this morning after a solid revenue beat and some very optimistic guidance. CEO Chris Rogers says their AI-driven customer approach is actually paying off, which is a nice contrast to the AI fear we discussed earlier. In the tech and gaming space, DraftKings is taking a hit, plunging on its latest earnings report as it struggles with rising costs. However, it's not all gloom in the S&P 500 tech sector. Both Arista Networks and Applied Materials saw their stocks jump following strong earnings. Applied Materials, in particular, is benefiting from continued investment in semiconductor manufacturing equipment. It's a very bifurcated market right now. If you're on the right side of the AI and manufacturing build-out, you're winning. If you're a consumer-facing platform like Pinterest or DraftKings, the current economic headwind is becoming a gale.
Looking at the international corporate landscape, the theme of reevaluating growth is everywhere. Beyond L'Oréal's luxury slump, we're seeing a fascinating trend in Brazil. Cogna Educaco, a for-profit education company that was once a pandemic meme stock, has seen a staggering 200% rally recently. It's a sign that retail investors are still looking for high-risk, high-reward plays in emerging markets, even as the meme stock era feels like a distant memory in the US. In the tech infrastructure space, new data shows just how dependent Europe has become on American cloud services, with US companies now holding 85% of the European cloud market. This is sparking renewed calls from the European Central Bank for more centralized oversight of large asset managers and tech infrastructure to ensure the bloc's financial stability. We're also seeing some movement in the mining sector out of China and Africa. CMOC Group, which we mentioned is joining the Hang Seng, is becoming a powerhouse in the cobalt and copper markets, which are essential for the EV transition. However, even these giants are wary. The threat of global trade wars is making companies very cautious about their 2026 outlooks. Even in the crypto world, the exit ramp seems to be the preferred route for many right now. Standard Chartered just lowered its Bitcoin forecast, suggesting we could see a dive to $50,000 before any meaningful rebound. Investors are clearly looking for safety, and right now, safety is a moving target.
On the policy and geopolitical front, there's a major trade development to track. The U.S. has officially signed a trade deal with Taiwan, lowering tariffs to 15%. In exchange, Taipei has committed to purchasing over $84 billion of American goods, ranging from energy to aviation products. This is a massive move for the America First trade agenda and will likely ripple through the aerospace and energy sectors. Meanwhile, back at the Fed, the cooler CPI report we mentioned earlier has kept the possibility of at least 2 rate cuts this year alive. Treasury yields fell on the news, with the 2-year note being a particular focus for traders. However, it's not all smooth sailing. U.S. Customs has identified a $3.5 billion shortfall in surety bond funding, a direct result of the record-breaking volume of tariffs being processed. This is the kind of plumbing issue in global trade that can cause real backups in the supply chain. In Europe, the political focus remains on Ukraine, with Polish officials pushing for a larger European role in peace talks. Between trade deals in Asia and shifting defense priorities in Europe, the geopolitical landscape is moving just as fast as the markets.
To wrap things up for our investors, here are the key takeaways for February 13th. First, inflation is cooling. The 2.4% CPI print is a positive sign, but the market isn't celebrating because it's distracted by the disruptive threat of AI in traditional sectors like trucking and real estate. Second, tariffs are no longer just a political talking point. They are hitting earnings now, as seen with Pinterest's massive drop. Third, commodities are in a period of high volatility. Oil is down on easing Iran tensions, and aluminum is sliding as tariff rules are narrowed. And finally, the crypto market is in a risk-off phase, with Bitcoin and Ethereum struggling to find a floor.
That wraps up today's update. I hope you gained useful insights into this complex pre-market picture.
Add your thoughts in the comments and follow for more such updates. This is Sarah
And Joe, signing off.